Good afternoon and welcome everyone to the Trading Talk Uncensored live Q&A session. My name is Danny and I will give you the webinar today. Okay, so we will begin as we saw in the agenda with the previous questions. We'll see what the first question is. Okay, so the first question is there a difference between trading on the phone to trading on the computer? Okay, so is there a difference between trading on the phone to trading on the computer? The answer is obviously yes, unless you've got a very big, very big phone. Of course, there is a difference since the phone is casually will be smaller on average than a computer screen, and of course, on the computer screen we can have multiple screens through an HDMI connection or otherwise, and we can have multiple charts displayed very widely and nicely. I'm sure there are some ways to also do it through the phone, but typically if I'm trading on the phone, it will not, probably again, I won't have a stable facility connected to multiple screens that allows me to simultaneously watch the market and do the analysis. But on average, on a regular phone, on a regular smartphone, of course, this is also to establish something very important. What I'm referring to using a phone is obviously a smartphone. Yeah, a smartphone with our app, which is our trading app. Okay, AvaTrade Trading's app. It looks very much like that. Once again, on the phone, it's a bit smaller, and also the state of mind trading on the computer. At least this is, of course, my personal opinion. Some people can say otherwise, but I think if I'm trading on the phone, it's probably on the go, and it's probably not for a session that is not too long, right? I don't think that I'll feel comfortable trading on my phone for 3-4 hours. Okay. But I think that on the computer, when it's stationary and it's well organized, that I said, with the right with the screen and with everything nicely, and I can have myself maybe a drink with something with sugar that allows me to maybe focus a bit better on the charts, and then I think it's more comfortable. Of course, again, everybody can do what they want, but that's what I think. In terms of functionalities, it works the same way. If I buy or sell on the phone, if I buy or sell on the computer, it's still the same. Okay, I do think that in terms of network, but this is again just my personal opinion. I think that if we're connected through a cable, so the connection is maybe a bit better, a bit more stable on the computer than on the phone. So this is another thing to think about. So actually, the answer for this question is quite simple. So we're going to type typically a phone will be typically a screen on the phone will be smaller than a computer screen. And as what we said, with being able to upgrade this facility to multiple screens, maybe on the phone this could be done as well, but I don't think it's a casual thing to start connecting cables into a phone and display on multiple screens the same way we do on the computer. So this is one thing, and also trading on the phone is casually on the go rather than on a computer that is stationary. This is also, we evolved so much that now we've got laptops and we've got mobile. We can even carry a laptop and trade on a laptop on a train or on the bus. But again, the point here, this comparison here, is between a phone to a computer that is a stationary computer with the right facilities. Otherwise, it's quite similar to a phone, just a bit bigger, right? If I have a laptop on my lap and I trade on a laptop, or I'm holding a phone, so it doesn't really make a lot of difference. Maybe just the system, operation system might be different. Maybe just it's very much like trading on a tablet, I think. That's give or take what I think. This second question, but like we said, the functionalities in terms of buying and selling are the same as long as we are using the same platform. Of course, MT4 and MT5 are different. The web trader MT4 and MT5 are different also, but they do interact. This is one thing we need to also to remember. I can trade on the web trader, modify on MT4 or MT5, and vice versa, since they are all connected. Okay, they're not connected to each other, but they are connected to the web trader. Okay, the next question here is, can I trade indices with $100? So let's put that to the test. We're gonna have it in with, let's click here on indices. And under indices, we'll select one of the indices. We'll give it a moment to load all the necessary data. We'll take FTSE as an example. And with FTSE, we're gonna click here on buy. We're gonna click here on the two arrows to expand the screen. And now with FTSE's open, let's maybe take place here one lot. I could go for 0.01, but well, let's have it for one lot. That means 10 indices. Okay, and for that, where is our, there we go. Okay, so we'll put the name of the instruments we're analyzing. We'll also put the price per indice. Okay, per unit, because we want to keep it as a formula. So the price per unit at the moment is 9,139. Okay, since this is the account is in dollars, so the results will reflect in dollars. But we need to know that FTSE is a UK indice. Okay. All right, so the price, as we said, the price per unit is 9,139. Okay, the number of units in one lot is 10, as we can see. Right, so if I'll click here on instrument details and I'll scroll a little bit down, we see here that the lot size is 10. I can just as much, I can place here 1 and then I've got it. Okay, so 10. And now if we go price per unit times number of units equals value. Why am I writing this down? Because what I'm going to do is a quick comparison between several indices and see if we can trade with $100. So the calculation that I'm showing you here is because I want to show the process of how it can be done. Maybe let's go for the minimum. We'll go for the minimum. Now, as you can see, this is 10% of an indice, right? It's less than one indice. Okay, but now it's one. Sorry. Now it's one indice. Okay, and if we'll switch like this, then we can see that now it's 0.1. And if we have 1, so it's 10. Okay, and if we'll multiply this by that, how much we get? This value. But we need to remember that this is the value in dollars converted from pound. Okay, converted from pounds. So if we'll do the process, the conversion rate, we'll see that this is what we're going to get. So Just going to quickly calculate this outside and then bring it into this screen. Okay, so what we can do is we can minimize this, or we can click here and then click here and split the chart to two. And then we're going to click on the other chart, click in here, and then go USD GBP. Oh, sorry, the other way around. And then we'll select it from the list, and we can see that the conversion rate is 1.35. So if we will follow the equation we've got in here, and then we will go, let's do it together. So price per unit times number of units. Price per unit is 9,139 times number of units is 10. So we need to get 91,390, right? Okay, we'll do it together. Okay, great, great. But because this is in pound, we have to multiply that by the conversion rate. What is the conversion rate? Let's look, 1.35. So we'll multiply. Okay, and then this is what we have. So this is only because this is an indice that is in pound and our account is in dollar. But if we'll make a quick comparison, so what I want to show you, the reason that I've showed you is, as you can see, the margin impact here is a result of if we divide our value by the leverage. Okay, so we've got the price per unit, the number of units. This is the sum that we wrote down. And we've got another factor we need to acknowledge, which is the leverage. The leverage at the moment is 1 to 20. And what it does is it multiplies buying and selling. Okay, great. What does that mean? It means that our account with 10,000 will behave with, especially for FTSE, will have 20 times more in terms of buying or selling ability. Okay, it doesn't affect our balance in any way. It just gives us a multiplier to acquire more units. I don't have to remember that because it's already written in here. Okay, so with the same logic, I can just divide the value by the leverage, and then what I get is the margin impact. And in this case, if we'll divide 123,376 by 20, we get 6,190. Okay. All right. So let's make another comparison with another instrument. And as you can see, the question here was to trade indices with $100. And if we'll minimize this to the bare minimum, 0.01, we're able to take 1 unit. We're able to take 1 unit because actually with this size of account, we could have done it even without the leverage, but we can do it more easily because we've got the leverage, and this means that we only need what? We need 5% out of the general value of the position. So 5% is exactly that. Okay, great. Now that means that FTSE, okay, with $100. So for FTSE, the available position we can take is 0.01, and this will be $61 and $89. Okay, great. If we'll put something else on the line, not a UK indice, but something, let's say Nasdaq is an example, and we can focus on that. So we'll click in here, and then we'll click in here, and we'll put Nasdaq on the line. Okay. And we'll also click here on buy, and we'll also make the same comparison and see that this is 0.01, and Nasdaq's value per unit is 23,385. Okay. Number of units, we'll keep it as 1. This is why if we'll use the same formula, what will happen is the value stays the same, right? 23,385 multiplied by 1. That's exactly the same thing. Okay, great. Which means all we gotta do now is just divide this also by the leverage, which appears to be 20 as well. And if we divide, what do we get? We get 1,169. Great. Is this something that we can trade with $100? The answer is no. Nasdaq equals 0.01. That will be 1,169. Okay. In this case, the question here is referring to indices, but the question is to why? Because there are some indices that we can and some indices that we can't. In this case, the answer that I'm going to write here will be depending on the leverage and the margin requirement for each index, we can now know we can know how much we need. So depending on the leverage, the margin requirement for each index, we can know the general necessary amount for the whole strategy. Okay, and as we saw, the leverage was the same. But we need to know that the leverage can be different. It's not always going to be 1 to 20 or anything permanent. It can be different from each index to each index and different instruments. Now, depending on the leverage, the margin requirement for each index, we know the general necessary amount for the whole strategies. Some of them we can, some of them we can't. The margin impact is what we're looking for, and this is what we need to have available to open the position. In other words, even if my balance is 100, but I took a position with FTSE as we saw, and I want to take another position with okay, I'm trying to think about an index that will be okay, let's click here, scroll down and choose it from the list. This would probably be with the same leverage, so it doesn't give us a lot. But what we can is maybe go with this, expand, click buy, and watch the margin impact in here as well. And we can definitely trade US 2000. Okay. And as you can see, the margin requirement. Oh, sorry, no, we can't. With $100, we can't. Okay, it appears that some of the indices, as I've explained, some of them we can and some of them we can't. As you can see, no, Swiss also not available for us to trade with $100. Okay, as you can see, if I'll go through all the other indices, you will see that it might be very challenging. The leverage seems to be that it keeps it's 20 for everything we saw till this point, but it's important to know that it can still vary. Yeah, this is basically how you can do it. Watch the margin impact, make sure that it's available, and then you know that you have the ability to take the position. Of course, with a $10,000 account, all of those things that we saw till this point are available for me to trade. But with a $100 account, this will be very, very challenging. Okay, so we can carry on. How often should I withdraw my profits? Well, this is also, not anything concrete. Maybe we can withdraw every week or every month or every once a year. That depends on what we need, and also that depends on the strategy we're using. So if I've decided to compound this year and maybe to withdraw at the end of the year because I would like to have additional margin to trade with, so I can do that. If I want to use my account for secondary income and withdraw profits every month is an example, so I can do that as well. What I need to know, what I need to remember is how much I need to begin with in every month. When I'm using my strategy, I need to know how much margin to prepare. The same exact way that we did now with the indices, I can select any other instrument that I want to trade. Okay, and with this instrument that I want to trade, what I want to do is I want to know that I have the available margin to trade in each whenever I whenever I want to make the withdrawal. I'm not going to withdraw everything and leave myself naked, right? What I want to do is I want to do it wisely and to leave my account with enough margin. So I'll always keep the margin level healthy, and this way I can carry on with ease. Like I said, I can compound, I can withdraw every now and then, whatever we want. There is no specific rule for that, as long as what we withdraw leaves our doesn't leave our account vulnerable. Okay, so we don't take too much margin that we might need in the account. Okay, so how often we can withdraw? Whenever we want. Before making a withdrawal, I should consider how much margin I would like to keep in my account to perform my strategy safely. I don't like to use the word safe because nothing is safe, but you understand what I'm explaining here, right? If my account is with $1,000 and I withdraw 500, my strategy is based on having $1,000. I might be more vulnerable, and my ability of buying and selling might be less. Okay, so that just makes sense. The last question we've got is how to use execute when price hits. Basically, we can click in here to fold it down. We're going to click in here, take the question, paste it in our notepad, and now we'll see that to the right, we've got here 3 pending orders, 3 boxes in here. The top one is execute when price hits, which basically behaves as a pending buy or a pending sell. We're also familiar with a sell limit and a buy limit from MT4 and MT5. If we click in here, it allows us to automate our entry. Why would I want to do that? Because if, for instance, I think that Dash, just a second, guys. Okay, so let's suppose that at the moment we're looking at Dash, one of the cryptocurrencies, and okay, let's suppose at the moment we're going to click here, take a price line, place it here, the previous resistance, another one a little higher. It's less relevant for us, and a previous support, we can't even see that. Okay, there's no previous. And at the moment, let's switch to weeks. Okay, and with with the weeks in mind, at the moment we're seeing the Dash is a 22.4, and if we will just a second, And if we think that Dash can possibly recover, but we see that it can also go down a little bit more, another $5. Okay, and let's suppose that at the moment I don't think that it's safer because I suspect that it might go a little farther down. What I want to do instead is I want to get a buy in a better position after it already started the correction. How can I do that? I can do one of two things. Let's suppose that I want in advance, I know that I want to buy it when it will reach 27. I can do one of two things. A, I can wait by the computer. Okay, remember, we're looking at weeks, right? So as we can see, it hasn't been on that price since when? Let's see, just a second. We can see that the last time that it's been on that price was March. Okay, so statistically, if I'm looking at how many months have passed since it's been on that price, which is 27, that was a little more than 3 months. Okay, so either I will wait by the computer for 3 months, okay? Of course, it doesn't have to take 3 months. It can happen in a day. Okay, if we switch to days, we can see if we switch to days that now it's been bearish for 2 days. Okay, but if it wouldn't go down, let's look at the size of those candles and we can see the structure of this candle that started at 25 and have gotten to 22. So this could easily be the other way around, right? We can definitely see that. In this case, and if we get this nice structure that I'm looking for, I want to buy at the peak. I want to buy at the peak and I want to locate my stop loss a little farther down and my profit way, way higher. So for instance, in this specific example, what I would want to do is maybe target the, in this case, let's maybe clear the drawing. Okay, and what I want to do is to buy at 27 after it started the correction. And I want to target something a little higher, maybe, just a second. Let's say 32. Okay, let's say 32 is what I want to target and I want to buy it in here. So I can do one of two things. Either wait by the computer and as soon as it gets to that level, I'm going to hit the buy button and launch the position, or I can automate my entry. How can I automate my entry? I'll enable here the box with execute when price hits, and in here I'll type the price 27. What will happen in this case is it will automate the entry to be triggered when it will reach 27, and I can also automate when it will be closed. I can automate the take profit and the stop loss, but I cannot determine when it will be closed. Okay, it's important to know that regardless what we're planning, the market still moves in his own pace, in his own way, and we cannot determine or judge anything like that. Okay, but we're doing our best to analyze and optimize. So we're looking at closing the position at 32. We're looking at taking it 27. Maybe stop loss can be a bit farther down. We'll make it 25. We are with a buy. Okay. Okay, so there is a limit. Okay, we'll enable this again. Okay. And at the moment, as we saw, this is what we've got, right? This is what we've got. We can automate the entries we saw. If we select another instrument, as an example, we'll take crude oil. And we'll do the same exercise with crude oil. We'll clean also the slate here. And this time we'll do it the other way around. So we can see that crude oil is a bit bearish for the past 2 weeks. Full switch today, as we can see that it's also in the middle of ranging through those levels. We'll have a price line in here, maybe have one in here. And then let's suppose that I don't want to buy currently, but instead what I want to do is to buy at 65, a flat 65. What I can do then is I can click on buy, and in here click on take profit, click on stop loss, and click on execute when price hits, and set my entry to be a flat 65 with the take profit half a way up, which will be 67.5. And stop loss can also be 2.5 down, so this will be 62.5. Okay, and this way I've fully automated my entry and my closing. Okay, this is how I can use execute when price hits. As you saw, I can either use it for reversal or I can use it for an uptrend to take a buy, to take it trade with the trend. So I hope that this was useful. Of course, if there are any questions, guys, you're welcome to fire away. I'm happy to answer any questions you've got. Okay, so at the moment, how to use using the function execute when price hits is similar to using a buy limit, buy or sell limit or stop on MT4 and MT5. It allows us to automate the entry to a position. Okay, great. Great. The next segment, as we saw, is informative to share with you those links. We'll share with you the link here for more education for our education section. And I'm also going to show you a few things that we've added to the website, so you don't even need to use those links since you can get there directly. Okay, but still, it's good to have those links. So you will, this will save you the trouble to find it by yourselves on the website. This is for a real account. If you're still on the demo and you want to practice, with the live market, with a real account. Lastly, we'll have the academy. This is, as I said, something that I would like to show you how to get from the website. So what we're going to do is we'll fold it down, and in the default interface, we'll click here to get to the default interface. And in the default interface, here to the left, we've got all those nice menus. And at the bottom of those menus, we've got just above the chat, right? We've got the education, tutorials, and academy. If I'll click on the academy, exactly what it does, it takes me to the academy. If I'll click in here and click tutorials, it does open the tutorials, and I can right away, without even leaving the website, get full access. I've got here tutorials with sound. Okay, so we'll click in here just like that. We'll give it a moment, and we've got subtitle and everything. Okay, everything is ready for us to just dive in and learn more. So I recommend you guys to check that out as well. And as I said in the beginning of the webinar, the recording of this webinar will be uploaded to YouTube, to our channel. And there you can find a lot of useful content regarding analysis, risk money management, and so much more. Before we say goodbye, I would like to give you here the one-on-one premium market review special promotion code, which is the Q&A benefit. What it means is that you can give this to your senior account manager, and he can give you a one-on-one premium market review, which, to my opinion, can be extremely, extremely useful. So take advantage of that. Until that, guys, thank you all for joining us today. I hope that you've learned something you can implement in your own strategy. Until then, I wish you a fruitful week. Best of luck with trading and have a good day.